So now let's return to constructing financial statements and this series of assignments in which we're looking at Rocky Mountain Catering. And this will be part 3, in which we construct the year-end balance sheet. Recall that we've already put together an initial balance sheet for the firm given a set of initial conditions. We then put together an income statement for the firm's first year of operation given a series of transactions. Now we're going to create the balance sheet for the end of that same first year based upon those transactions and based upon other decisions that Jessica and Sean have made. The Constructing Financial Statements videos for Rocky Mountain Catering will assist you in completing a set of financial statement assignments in this course and help prepare you for the review problem at the end of the course. We're following Rocky Mountain Catering from the formation of the firm, referred to as the initial condition, through the first year of operation. We'll use the information provided to construct a set of initial balance sheets, the company's first year income statement, a year-end balance sheet, cash flow statement, and statement of stakeholders' equity. So remember Jessica and Sean. They love to barbecue. They love to make artisanal sourdough breads in Dutch ovens. They do this for family and friends. And in fact, they loved it so much, they decided to see if they could turn their hobby into a business. In their first year, after having borrowed $100,000 to put into the business and used $50,000 from their own savings, they decided to go ahead and launch the business. They had a successful first year. They had $750,000 in gross revenues. That resulted after cost of goods sold in a gross profit of $450,000. After another $372,500 of operating expenses, they then were able to post an operating income or EBIT of $77,500. And after paying interest expense and taxes, that resulted in a net income or profit of $49,950. And I think we would accept that this is a success by almost any measure. So let's take a look at the balance sheet representing the initial condition for Rocky Mountain Catering and for the income statement representing the first year operation. Notice that for the initial condition for Rocky Mountain Catering, we have $60,000 in fixed assets. This is prior to those being depreciated. And the reason we don't have any depreciation yet is because no time has lapsed from the moment that they were acquired to this initial point in time. We'll find that there is time that has lapsed by the time we end up at the end of the first year. So we have $60,000 in fixed assets. We have $100,000 in debt, $50,000 in accumulated retained earnings and founder's equity or common stock. So total owner's equity of $50,000. So on the right-hand side of the balance sheet, we end up with 50 plus 100,000 or 150,000 in total liabilities. And on the left-hand side, for the balance sheet to balance, we must have the $60,000 in fixed assets plus $90,000 in cash or current assets. And when we have that, the balance sheet balances. But notice here that I said for this to balance, we must have the $90,000 in cash. If we have $150,000 on the right-hand side, and we know that we have gross fixed assets, in this case the same as total net fixed assets of $60,000, there must be $90,000 in cash. We would then validate this by taking a look at our cash accounts and make sure that there is indeed $90,000 there. Well, similarly, we ended up at $750,000 in revenue for that first year. So now a year has gone by from the initial condition, $450,000 in gross profit, $77,500 in operating income, leading us to $49,950 in net income or profit. So now with those transactions, looking at the initial balance, the transactions for that first year, let's try to go ahead and create a year-end balance sheet for the company, representing not the initial condition, but the condition after 1 year. So in this year, the company had a profit of $49,950. The stakeholders, Jessica and Sean, chose not to take any dividends or distributions and left all $49,950 in the business. So these are the retained earnings they've retained to reinvest in the business. They received all but $15,000 of their first year revenues in cash and credit card payments. So there are some of their customers or clients that owe them $15,000. We'll think about those as accounts receivable. Those will become part of the current assets on the balance sheet. They paid for all but $10,000 of their purchases during the year. So that $10,000 that they owe their vendors, probably for raw materials, maybe barbecue products, maybe wood for the smokers, whatever it might be, we'll consider that as $10,000 of accounts payable. And we'll see that then on a year-end balance sheet. Remember that the company had zero retained earnings coming into this first year because they had an initial condition. There had been no profits, nothing to retain. And also because it was an initial condition, they hadn't started to do any work for anyone yet. They had no accounts receivable and they had no accounts payable. In addition, they've chosen to use some of their cash on hand to pay off $10,000 of the business loan. This should reduce the amount of interest that they'll have to pay in future years. They also chose to purchase an additional smoker at $8,000 and invest in a walk-in refrigerator at $20,000. So we're going to see that there's a $10,000 reduction in long-term, which is going to be some drain on cash. But we're also going to see that it affects the balance sheet. So let's look at what we've got now. We identified that we've got $15,000 in accounts receivable, and we have $10,000 in accounts payable. We didn't have either of these under the initial condition, but we do now. In addition, we apparently have acquired an additional $8,000 in the way of a smoker. We saw that. Another $20,000 in the way of a walk-in refrigerator. So our gross fixed assets have gone from $60,000 at the initial condition to $88,000 by the end of the first year. And by the end of this first year, we now have some depreciation we can claim, $7,500. And that $7,500 is 1/8 of the $60,000 of gross fixed asset. So why are we taking 1/8 of the $60,000 rather than 1/8 of the $88,000? And that's because we acquired the additional fixed assets at the end of that first year. So the $8,000 smoker, the $20,000 additional equipment in the refrigerator, walk-in refrigerator, we didn't own those during the year to depreciate them. We bought them at the end of the year. So there is no amount of time for that depreciation to have taken place on those, but we have an entire year's worth of depreciation that is taking place on our initial asset. So we look at this at the end of the year. We're saying we now have $80,500 in net fixed assets. We have $15,000 in accounts receivable, $10,000 in accounts payable. We paid off $10,000 of debt, so we now only have $90,000 of long-term debt rather than the $100,000 we had. We began with the initial $50,000 of common stock. We are adding $49,950 to accumulated retained earnings, such that the right-hand side of the balance sheet now adds up to $199,950. If that's the case, the only way for the left-hand side of the balance sheet to add up to the same dollar is if our cash is $104,450. Once again, we would accept this number, but validate it by checking our cash accounts at the bank. And if those accounts differ, then we have to go through, audit our numbers, and see where the error lies. You'll also find that when we look at the cash flow statement in the next video in this series, we'll go ahead and see how we solve for that cash amount so that everything does balance. And after solving for the cash amount, we would then again validate that that's actually how much cash we have in the bank. You should now be prepared to complete the Rocky Mountain Catering year-end balance sheet assignment. This is the third in a series of assignments to assist you in better understanding the construction of financial statements and prepare you to complete the review problem at the end of the course. My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.